In the aftermath of Russia's full-scale invasion of Ukraine, Western governments took an unprecedented step. They froze hundreds of billions of euros worth of Russian central bank assets held in their own financial systems. Now, just over 2 years into the war, the pressure is mounting to go a step further, not just freezing those assets, but using the interest they generate and possibly even the assets themselves to help finance Ukraine's war effort and post-war recovery. At the center of this debate is the European Union, whose banks hold the largest share of the frozen Russian funds, amounting to nearly 210 billion euros, most of it sitting in Belgium's clearinghouse, Euroclear. So far, the EU and its allies have been cautious. While freezing assets was a significant move, outright confiscation is even more complex, raising issues of legality, precedent, and potential blowback. Recently, proposals have gained momentum in Brussels, Washington, and London to use income earned from the frozen Russian assets as collateral for a massive new loan to Ukraine. The plan being discussed is centered around a €50 billion loan from the EU, with talk of a broader international package potentially reaching as much as €140 billion. The core idea would be to securitize or backstop that loan with the interest payments generated by the immobilized Russian funds. By leveraging assets sitting dormant in Western institutions, the West could deliver a significant financial boost to Ukraine without asking taxpayers to directly shoulder the full burden. Supporters of the plan argue that it is both morally justified and economically sound. They point out that Russia should pay for the damage it has inflicted on Ukraine, a bill that now far exceeds €400 billion. According to the World Bank, given that international law prohibits wars of aggression, the thinking goes, it is only fair that Russia's state assets help rectify the consequences of its illegal actions. Yet, there are major legal and practical hurdles to confront. International law traditionally protects sovereign assets held abroad from seizure, even in times of war. Some governments and central banks worry that breaking this norm could undermine trust in the global financial system, encouraging other countries, especially autocratic ones, to pull their reserves out of Western institutions. The fear is that such a precedent might boomerang, weakening the stability of the very financial order that allowed these sanctions to have such an impact in the first place. Then there's the delicate diplomatic balance within the EU. While countries like Poland and the Baltic states are eager to move aggressively, key players such as Germany and France have adopted a more cautious stance, concerned about possible legal challenges and about maintaining EU unity. Belgium, home to Euroclear, is also walking a diplomatic tightrope, eager to shield its crucial financial sector from retaliatory moves. Practical implementation is another gray area. The simplest step and the one with the most support is to take the interest earned on the frozen Russian assets, which currently amounts to nearly €3 billion a year, and use it as a steady source of financing for Ukraine. But if the international community moves beyond interest and towards the underlying assets themselves, it would require carefully crafted legal justifications either through international legislation or individual national laws. There is also discussion about using the assets to underwrite a much larger loan package, effectively using Russia's money to guarantee the repayment. This approach could significantly expand the financial resources available for Ukraine's defense, humanitarian needs, and eventual reconstruction. Yet, even this carries risks. If Russia were to retaliate against Western businesses or assets inside Russia, the economic cost could rise sharply. There is also uncertainty over what happens once the war ends or in the event of a negotiated settlement. Would the assets remain confiscated, or could they be used as a bargaining chip? Would using Russian funds this way drive a permanent wedge between Russia and the West, or could it eventually help lay the groundwork for reparations? Adding another layer of complexity, there is not yet a unified Western approach. While the US and UK have signaled cautious support, the European Union's decision-making process is slower and depends on all 27 member states reaching consensus. The question of how, when, and under what legal framework the assets could be used remains unsettled. As the war drags on and Ukraine's economic needs grow ever more urgent, pressure is only building for Western powers to act. For Ukraine and its allies, the potential access to up to €140 billion without straining Western budgets could be a game-changer. But the unanswered legal, financial, and strategic questions mean that, for now, these assets remain in a state of limbo. In the coming months, the story of what to do with Russia's frozen assets will likely remain at the center of Western policy debates. How leaders resolve it will not only determine Ukraine's reconstruction prospects, but may also shape the future of international finance, the rule of law, and the global response to acts of aggression for years to come.